In this video, we're going to talk about Paysafe, trading under the ticker symbol PSFE. Paysafe is a company operating in online payments business with branches of storage and payment products for both individual and commercial clients alike. It is the parent company for applications like Skrill, eCash, and NetTeller. Its offer of value is to facilitate users to exchange money online without going through the banking system and avoiding the huge fees. The appeal to the market is that Paysafe is a company that is recently introduced to the stock exchange and therefore attracts a lot of attention, which translates into higher trading volume and, to an extent, to its future performance. Its stock price is fairly volatile, which can provide good opportunities to make gains by selling at the right moment. Like many other companies of the same sector and era, Paysafe seems to have a following online among the retail traders who are willing to be patient with it and to even increase their investments despite a decreasing stock price since it got introduced to the stock market. The trading volume of Paysafe has recently been 4.6 million shares compared to an average volume of 9.8 million shares. Over the previous 52-week period, its price has fluctuated between $3.18 and $19.57. The market cap of Paysafe is currently at $2.8 billion compared to an enterprise value of $6.5 billion. The difference between market cap and its enterprise value is the premium or discount financial market is usually willing to allocate to the company based on its current fundamentals, leverage, attractiveness, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact its profitability and solvency. Another key element to understand is the asset composition of many companies, and it is especially true for growth-type companies. For quite a few of them, one of the most significant assets they own is called goodwill. Goodwill is basically the expectation of the market that the company is able to generate more profit and more growth than the competition because it may have a good management, it has stronger brand recognition and bigger online following, and so on. In other words, it may not be a tangible asset that companies can use, but it's an asset that companies can add up to their asset valuation so that when we look at the market cap and the EV, they may be trading at a discount, therefore give us the impression that it's a deal to buy them now. It's not always the case. We gotta see whether they have a lot of goodwill on their balance sheet. In comparison to its historical price fluctuations, the stock is 12.9% higher than the 1-month low, 23.9% higher than the 3-month low, and 23.9% higher than the 52-week low. In terms of the options market, which often gives a hint on the market sentiment on where the stock price is likely going to head toward, the implied volatility here is 61.2% compared to a historical volatility of 60.3%. The put-call volume ratio for Paysafe is 0.15. The most recent volume of options traded has been 12,000 contracts within a day compared to the 30-day average of 9.5 thousand. In terms of open interest, the most recent volume of open interest has been 265,000 contracts, and this is compared to a 30-day average of 311,000 contracts. Regarding its shareholder structure, institutional shareholders own about 44% of its outstanding shares. The biggest shareholders include Blackstone, BlackRock, and Fidelity. The relevance of the shareholder structure is important to determine whether you should be holding the stock long-term or to view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term holding from shareholders. Of course, there are a lot of exceptions from what I said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Let's also look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, it can be a sign that there is an organized shorting operation going on, like what has been going on with GameStop and AMC. The current short interest is 4.1% of the total floats and 44.7% of the dark pool transactions. Now, let's also take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. Oscillators are showing 0 sell, 9 neutral, and 2 buys, with an overall tendency of buy. The moving averages of the past price actions show 8 sells, 1 neutral, and 6 buys, with an overall tendency of sell. Moving averages can be used to determine whether the stock is overbought or oversold in the short term, which can be used to see if your trade is sufficiently well timed. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are currently $2.62, $3.69, $3.80, and for resistance levels, they are $4.29, $5.06, and $6.25. Looking at Paysafe over the past few weeks, I think that on one hand, investors certainly have hoped for a faster recovery than what happened in reality, and are also partially trying to convince themselves in an artificial way that things are going to go better. In a way, they were right. It's just a matter of timing and whether their exposure allowed them to wait for the market to eventually turn around. Theoretically, no stock is going to fall forever, and this also applies for Paysafe. The company was initially popular because it was recently introduced to the market. It was known to be part of the fintech industry and that it has many established names in its portfolio of companies. But because the fundamentals were not that great when they first began trading, the valuation got changed, and this has caused the chain of reactions that we now see. I think that fundamentally the company does have a lot of potentials, but also has a few question marks as far as those potentials can carry the stock. Keep in mind that fintech is a word that has been around for a sufficiently long period of time that it is no longer enough to just be categorized as a fintech company to have a high valuation. The new trend that has emerged since late 2021 and that is probably going to amplify in 2022 is that the market will favor companies that perform well from a fundamental perspective. From a tactical point of view, I think that the market is going through a correction or stabilizing phase, where the stock will find some significant support around $4 price mark, and that it should be reasonably safe to start building a position right now. I would recommend to keep an eye on Paysafe for volatility play and to keep a smaller position of your allocation. The maximum exposure I would recommend is between 0.5 to 1% of your portfolio. The holding period should be between 2 to 4 weeks before considering selling. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there. This money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.